Now, right now, my bet is this. You get gold back up to 2,800 again, or even near the high. And we're looking now at Feb gold starting next week, February contract. It's about 2680 right now. And I'm going to bet you silver's back to 35 pretty quickly. And when it is, I think at that point you're going to see that silver-gold ratio change dramatically. There's some major banks in the U.S. That have sort of gotten on the gold bandwagon recently. And I think it was BAC, Bank of America, that recently said 2025 is going to be silver's year. And, I think they're right. Now, they're late. We got bullish on silver, back in 2015 when it was 15 bucks, and then, et cetera, et cetera. And we re-entered again. We said, if you're not in, get in at 25, 26 back in March. Okay, yeah, it's pulled back some, but if you got in then, you're still well ahead. But it's got certain fundamentals that people in the industry are aware of, but most investors really aren't. And that is, it's an industrial metal, too. So it has its own supply-demand problems. Particularly supply is fairly stable, not growing at all, whereas demand is growing, particularly among the Chinese, because the Chinese make, like 80–90% of the global solar panels, and the voltaic cells, and they need silver in each of those. And the rising price of silver doesn't really hurt the price of the solar panel, doesn't affect its marketability, even if silver went up. But the problem is the supply is not growing, and their demand is growing parabolically. And so, when you were a kid and I was a kid, silver industrial demand was photographs. It was in the film. Well, now it's gone, okay. But solar panels, which are, and you have to be green to understand this. In Africa and a lot of the developing part of the world, there are not the convenience of underground wires from a power station. You're out in the middle of the boondocks, and you've got a cell phone and things like that, but you don't have a constant power source. Therefore, mobile backyard power units are selling like hotcakes. And even in the U.S., I understand demand is off the page, particularly in Texas, where they get wiped out every year. The storms come in and they're down for 2 weeks, that type of thing. But solar panel growth is growing dramatically, and it's in double-digit % annually. And so at some point, that's going to be an awareness button for investors. I argue that probably that won't be a provoking factor. It's underlying. But it'll become a public conversation once silver does shoot up big. Now, right now, my bet is this. You get gold back up to 2,800 again, or even near the high. And we're looking now at Feb gold starting next week, February contract. It's about 2680 right now. And I'm going to bet you silver's back to 35 pretty quickly. And when it is, I think at that point you're going to see that silver-gold ratio change dramatically. Now, we have certain levels that we measure technically, not just looking at the spread itself, but looking at the momentum of the spread that say it could really engage in a dramatic way. So it's like a jolting upturn. In other words, it won't be an arm wrestling thing. There's certain levels, if you reach them, that spread will just go berserk, like it's done before. And it's extremely cheap right now. Well, we've been focused on not just the monetary metals, which a lot of people do. If they're in the gold, they focus on gold, okay, or gold and silver. If they're in the stock market, they focus. But you've got to look at these as big tectonic plates moving, and especially now, one hitting the other can create major positive or negative impact. And we've been waiting for the cracking of the stock market bubbles, particularly the bubbles in the U.S., which is an enormous bubble. In other words, the number of years of duration of the bull trend, not counting and also the percentage gain is just awesome. Okay. They say, oh, that's because the economy's great. Well, it's also because they printed money and they made money free for 10 or 15 years. Okay, we know that. So we have a huge bubble. It beats 29, it beats 2000, it beats 2000. There's no comparison, those so-called bubbles. This one's monstrous. When it breaks, it will wreak havoc. Not just to people who own the stuff, people who have retirement accounts and suddenly they're down 20, 30% in their retirement account, and then they're being pinched on the consumer side as well, Now, and when that happens, that money goes somewhere. You go back in history and you find it's never the case that when the stock market collapses, everything goes down too. It goes somewhere else. Quite often it's into T-bonds and gold. That was true in 2000 to 2002, 2007 to 2009, big bear markets in the stock market, yet T-bonds and gold rose. This time I think it's going to be primarily the monetary metals. Now, obvious reason, the central banks go berserk. They have no choice. The notion that the precious metals have to go down with the stock market is not historically accurate. There have been a few times in the past 20 years where there was a point where the stock market dropped and so did gold. But it's usually rare and isolated. For example, in 2008, 1 year into that bear market for the stock market, you're already 1 year off the high, well off the price high. Gold had been rising all that time. But in October of 2008, the stock market did do a crash event where it went down over 30% within a matter of a few weeks. It was October of 2008, again, a year off the high. Gold joined in. But at that point, gold was technically vulnerable to have a correction. And for gold, that's all it was. It was like a 1 month event. And by early 2009, gold was back at its highs. Whereas it was till a couple of years later that the S&P could get back to its highs.
Yeah.
And gold continued up through too. So, but most of the time, that's not true. Gold, if it's technically vulnerable to have a correction, yes. But right now, no, it's not. It's ripe for an acceleration move. And I think that acceleration phase, which we've already entered in March, where gold started to really advance strongly. But it'll even do more so once that stock market starts to bleed and that money flows out and goes to a place that's behaving well. And you know, even some of the major banks and their analysts have said, hey, gold's behaving well. You know, it's going up. You know, reality has finally hit them. You know, it will hit them more once the public is hurt by the stock market decline. It's ever since March, remember from 2020 through early 2024, gold was in a range. Its maximum width was 20%. In fact, if you took off a couple of months in 2022 when you had that plunge, it went down towards 1600 gold. If you chop that out, it was really a 15% range. It was fairly trivial, you know, for a 3-year span. It finally broke through that stuff on momentum factors, annual momentum, quarterly momentum. Same is true with silver. Same is true with the gold miners, like GDX, ETF, and so forth. They all broke out via quarterly momentum and annual momentum and said, okay, we're tired of this 3-year baloney range. We're now awake again. The bull trend is reborn. And they shot up big. I mean, GDX, for example, went from 31 something to recently hit a high at 44. It's now about 38, okay? But it's still way off of the March breakout level. Silver was $25 to $26 when it broke out via our momentum metrics. Yeah, on a pullback now, it's about 31. Okay. Gold then broke out above 2,000, between 2,000 and 2,100 on our momentum metrics, and has recently hit 2,800. Now we're 2,660 as we speak. Okay. So well above that level. So it's already started to what you could call advance strongly. But it keeps having these pullbacks that everybody thinks is now the norm. In which gold goes up 2 steps, pulls back 1. 2 steps, pulls back 1. Everybody thinks that's now the new norm. And so all the technicians out there who were put to sleep or bored to death during the last 3 years, suddenly they have a new norm that's in play. It's a positive norm, but it's always going to correct. You could bet on it. And some of them say, oh, that was the top. Okay. Once that stock market starts to break and that money flow moves, then this advance in gold won't be 2 steps up, 1 back. Or for silver, it's been 3 steps up, 2 steps back.
Exactly.
You know, it's the wild dog on a leash. But still, it's an upward process. That norm, which broke the norms of the prior 3 years, okay, and a much stronger set of norms, will change yet again into a more dynamic norm, where instead of 2 steps up, 1 back, it's going to be like 5 steps up, 1 back, and in a jolting manner. But again, we need to have the fracturing of certain other asset categories to generate changes in money flow.
Michael Oliver makes some compelling predictions about precious metals, particularly highlighting how silver might be on the verge of a significant move. They're expecting gold to climb back to around $2,800, and when that happens, they believe silver could quickly jump to $35. What's particularly interesting is their perspective on why silver might be poised for growth. It's not just about its role as a precious metal, but also its industrial applications. They make a fascinating point about silver's use in solar panels, especially in developing regions where traditional power infrastructure isn't available. The Chinese market is particularly significant here, as they produce 80–90% of global solar panels, each requiring silver. Unlike traditional photographic uses of silver that have declined, this new industrial demand is growing rapidly, while supply remains relatively stable. Regarding market dynamics, they challenge the common belief that precious metals must fall when stocks crash. They argue that historically, during major stock market downturns, like 2000, 2002, and 2007 to 2009, money often flows into alternatives like treasury bonds and gold. They're particularly bullish because they see the current stock market as being in a massive bubble, larger than those of 1929, 2000, or 2008. One of the most interesting technical observations they make is about the recent break in gold's pattern. From 2020 to early 2024, gold was trading in a relatively narrow 20% range. However, they note that both gold and silver have recently broken out of their patterns on both quarterly and annual momentum metrics. They describe the current pattern as 2 steps up, 1 step back, but suggest this could dramatically change to 5 steps up, 1 back once we see significant movement out of other asset categories. These observations paint a picture of potentially significant changes ahead in precious metals markets, particularly if we see the kind of stock market correction they're anticipating. Of course, as with any market analysis, it's worth remembering that these are predictions, and the markets can always move in unexpected ways.